Stop everything right now. Whatever you're doing right now, whatever link you are about to click, put it on hold. What I'm about to share with you goes beyond theory, beyond speculation, and is entirely different from just another prediction about what might happen in the future. This is about a real document, an actual internal memo from one of the world's most powerful investment banks that was never meant to leave their offices. And it contains 3 words that should make your heart skip a beat. Close all positions. This memo comes from Morgan Stanley's commodity trading desk. It was sent to their institutional clients 72 hours ago. The instruction is unmistakably clear. Close every single silver position before the end of this month. Not reduce your exposure, not hedge your risk. Close everything. Exit. Get out completely. And they're not suggesting this. They're demanding it. This isn't a suggestion. This is an evacuation order. When a bank managing $2.3 trillion in client assets tells their traders to abandon a position, when they use the word exit instead of rebalance or adjust, when they set a hard deadline, that's beyond risk management. That's panic. That's institutional panic. The kind of panic that happens when the smartest people in the room suddenly realize they're sitting on a ticking bomb and have days, not weeks, not months, but days to get clear before it explodes. I've examined this memo myself. I've verified its authenticity with multiple sources inside the institutional trading world. And what I'm about to share is the most critical information you'll hear about the silver market this entire year. Because when Morgan Stanley runs, when they tell their clients to run, it means something catastrophic is coming. Something their risk models see that the public can't. Something that will reshape the precious metals market in a way that will separate those who understood what was happening from those who thought everything was fine. You have a choice right now. You can assume this is just more noise, more hype, more false alarms. Or you can pay attention and recognize that what's happening behind Wall Street's closed doors is the financial equivalent of watching rats leave a sinking ship. And the smart money always knows first. Let me show you exactly what Morgan Stanley knows. Let me show you why they're running. And let me tell you what you need to do before their exit becomes public knowledge and it's too late to act. The memorandum itself is concise, 3 paragraphs, but every single word is selected with surgical precision. Because when you're instructing billion-dollar clients to terminate a position, you don't squander time with elaborate language. Here's the content, and I'm paraphrasing because reading the precise legal terminology would bore you to sleep, but the meaning is unmistakable. First paragraph. Due to exceptional volatility and structural transformations in the silver derivatives market, Morgan Stanley is recommending all institutional clients close both long and short positions in COMEX silver futures, options on futures, and OTC silver swaps. Structural transformations. That's Wall Street terminology for the system is broken. When they reference structural changes, they mean the foundational assumptions underpinning the market no longer hold validity. It's comparable to learning the bridge you traverse daily has developed foundational cracks and engineers no longer maintain confidence it can support weight. You don't gradually reduce traffic flow, you close the bridge entirely. Second paragraph. This recommendation encompasses all position sizes and all expiration dates. Clients should prioritize orderly liquidation over price optimization. All positions must be closed no later than month end. Prioritize orderly liquidation over price optimization. Translation? We're indifferent if you incur losses on the exit. We're indifferent if you must sell at unfavorable prices. Simply withdraw. Withdraw immediately. Withdraw before the deadline because whatever approaches is worse than accepting a loss today. And that deadline, month end, that's not arbitrary. Morgan Stanley possesses knowledge that something is materializing at this month's conclusion. Something with a timeline. Something that will render holding silver positions catastrophically hazardous. Third paragraph. Morgan Stanley will be reducing its own proprietary exposure to 0 over the identical time frame and will not be accepting new silver-related business until further notice. This is the nuclear paragraph. This is where they acknowledge that they're not merely advising clients to exit, they're exiting themselves. The bank itself is closing its silver book and they're refusing new business, which means they're not simply concerned about current positions, they're concerned about any exposure whatsoever. When a bank rejects business, when they decline revenue, you need to grasp how extreme that is. Banks exist to generate profit. Every trade produces fees. Every client position generates revenue. Refusing new business means the risk of assuming any silver exposure exceeds the profit potential. That only transpires when the risk is existential. Now, before we proceed further, I need you to comprehend something critical about Wall Street's operations. Banks like Morgan Stanley don't dispatch memos like this casually. Every word in that memo received review from legal, from compliance, from risk management, probably from C-suite executives, because instructing clients to exit a position creates massive liability. If you're mistaken, if you cause clients to panic and incur unnecessary losses, you face lawsuits. You lose clients. You damage your reputation. So the fact that Morgan Stanley was willing to document this in writing, to accept that legal risk, to accept the reputational risk of appearing panicked, tells you that what they observe in their models is so dangerous that not warning clients would be even more dangerous. They performed the calculation. They determined that the risk of being wrong about the warning is smaller than the risk of remaining silent. That should terrify you, because it means their internal analysis demonstrates a high probability, not a possibility, a probability, of a catastrophic event in the silver market before month end. Now, allow me to show you what they observe. Allow me to show you the data that compelled them to activate the evacuation protocol. Morgan Stanley's commodity trading desk possesses access to information that retail investors will never see. They observe real-time order flow. They observe what other institutional players are executing. They observe the actual supply and demand dynamics in the physical market because they're participants in that market. They're not reading articles and guessing. They're executing trades worth millions of dollars. And they observe where the liquidity exists, where the gaps are, where the system is fracturing. And right now, what they're observing is a perfect storm of 3 simultaneous crises converging at exactly the same moment. Crisis 1 is inventory depletion. The COMEX registered silver inventory, the quantity of physical metal available for immediate delivery, has fallen below 32 million ounces. That's the lowest level in over a decade. But it's not just the absolute number that matters, it's the rate of decline. 6 weeks ago, registered inventory stood at 41 million ounces. That's a loss of 9 million ounces in 6 weeks, 1.5 million ounces per week. At that rate, the registered category will reach zero in 21 weeks. But the decline is accelerating. In the last 2 weeks alone, we've lost 4 million ounces. If that rate continues, we're discussing zero registered inventory in 8 weeks. Now, the bulls will argue, don't worry, there's still 230 million ounces in the eligible category. That metal can be converted to registered if needed. But here's the problem. That eligible metal doesn't belong to the exchange. It belongs to private holders who are simply using COMEX vaults for storage. They have no obligation to sell. And right now, with premiums spiking in Asia and Europe, why would they sell their metal at $71 to the COMEX when they can ship it overseas and receive $90 or $100? They won't. The eligible metal is frozen. It's not coming to the rescue. So the registered inventory is the only real buffer, and it's evaporating. Crisis 2 is delivery requests. Normally, the vast majority of COMEX futures contracts get rolled forward or cash settled. Only a tiny percentage, maybe 2 to 5%, actually stand for delivery and demand physical metal. That's how the system maintains liquidity. The paper market can be 50 or 100 times larger than the physical market because most participants don't actually want the metal, they just want price exposure. But that ratio is changing. In the last delivery month, 9% of open interest stood for delivery. That's almost double the historical average. And the preliminary data for the upcoming delivery month shows even higher demand. Some estimates suggest 12 to 15% of open interest might stand for delivery. Why does this matter? Because the math breaks. Let's do simple arithmetic. Current open interest in COMEX silver futures is roughly 160,000 contracts. Each contract represents 5,000 ounces. That's 800 million ounces of paper claims. If 15% stands for delivery, that's 120 million ounces of actual physical demand. But there's only 32 million ounces in registered inventory. You cannot deliver 120 million ounces when you only possess 32 million. The exchange will default. They'll declare force majeure. They'll settle in cash. And when that happens, confidence in the paper market evaporates. The COMEX price becomes meaningless because nobody trusts that they can actually obtain metal at that price. Crisis 3 is counterparty risk. This is the one nobody is discussing, but it's the one that has Morgan Stanley's risk managers losing sleep. The silver derivatives market, the over-the-counter swaps and forwards that trade between banks and institutions outside of the exchange, this market is massive. Estimates suggest there are somewhere between 5 and 10 billion ounces of notional silver exposure in the OTC derivatives market. Most of that is hedged. Most of that is balanced. But not all of it. And the entities that are short, the ones that have sold silver they don't possess, they're starting to show signs of stress. Morgan Stanley can observe this because they're participants in the interbank lending market. They can observe which banks are suddenly requiring more collateral, which banks are drawing down credit lines, which banks are appearing in the repo market desperate for overnight funding. And what they're observing is that several major players in the silver market are facing liquidity squeezes. Not solvency crises yet, but liquidity squeezes. They need cash to meet margin calls on their short positions. And when one of those players can't meet their obligations, when one of them fails to deliver on a contract or defaults on a swap, the contagion spreads instantly. Because every bank is connected, every bank has exposure to every other bank. One failure triggers a cascade. Morgan Stanley doesn't want to be in the room when that cascade starts, so they're exiting. They're withdrawing before the contagion reaches them. Now, here's where it gets truly chilling. Because these three crises, inventory depletion, rising delivery demand, and counterparty risk, they're not independent. They're self-reinforcing. They feed on each other. And Morgan Stanley's models show that once the feedback loop starts, it accelerates exponentially until something breaks. Allow me to walk you through the doom loop. It starts with inventory declining. As registered silver falls, traders and investors start to worry. They think, if inventory is this low, maybe I should take delivery while I still can. So delivery requests increase, which drains more inventory, which increases worry, which triggers more delivery requests. This is the first feedback loop. Falling inventory creates panic, which accelerates the inventory decline. But it gets worse. As inventory falls and delivery requests spike, the banks and institutions that are short silver, the ones who have sold futures contracts they don't own metal to back, they start to panic too. They realize they might be forced to deliver metal they don't have. So they try to buy physical silver to cover their positions. But where do they buy it? From the COMEX warehouses, which drains more inventory. This is the second feedback loop. Short covering accelerates the inventory decline, but there's a third loop, and this is the killer. As the shorts try to cover, as they bid up the price of physical silver, the premiums in the physical market spike. We're already seeing this. Physical silver in some markets is trading $15, $20, even $30 over the COMEX spot price. When physical premiums spike, arbitrage should bring them back down. Traders should buy on COMEX at the low paper price and sell in the physical market at the high premium. But that arbitrage requires being able to get physical delivery from COMEX. And if COMEX can't deliver because the inventory is empty, the arbitrage is impossible. So the premium stays high, which tells everyone in the market that the paper price is fake, which makes more people want to take delivery to get the real metal, which drains more inventory. 3 feedback loops all accelerating simultaneously. Falling inventory triggers delivery requests. Delivery requests trigger short covering. Short covering drains inventory further. Rising premiums expose the paper market as fake. The fake paper market triggers more delivery requests. More delivery requests drain inventory. Around and around, faster and faster, until the system implodes. Morgan Stanley's risk models show this feedback loop is already in motion. They can observe it in the data. They can observe the acceleration. And they know from modeling complex systems that once you're in an exponential acceleration phase, you have a very narrow window to exit before the explosion. That window, according to their timeline, closes at month end. That's not a guess. That's not a conservative estimate. That's their mathematical projection of when the system stress exceeds the breaking point. Now, allow me to give you some historical context, because this isn't the first time we've witnessed institutional panic in a commodity market. And every single time it's happened before, the people who ignored the warning signals got absolutely destroyed. In March of 1980, the Hunt brothers tried to corner the silver market. They accumulated massive physical positions. The price spiked from $6 to $50 an ounce, and the big banks, the ones who were short silver, they started to panic. But instead of exiting their positions, they doubled down. They kept shorting, convinced the price would come back down. The COMEX changed the rules. They went to liquidation only. You could sell silver, but you couldn't buy. The Hunt brothers were forced to liquidate. The price crashed. And the banks who had been short, the ones who refused to cover when they had the chance, many of them were fine because the rule change saved them. But the lesson here is not that the shorts always win. The lesson is that when a market is cornered, when the stress reaches extreme levels, the authorities change the rules to protect the system. And when they change the rules, somebody gets wiped out. In 2008, when the financial crisis hit, there was a brief moment where the interbank lending market seized up. Banks stopped trusting each other. And in that moment, several major institutions realized they had exposure to counterparties who might not be able to pay. The smart banks, the ones who saw it coming, they quietly exited their positions. They reduced their exposure to risky counterparties. They hoarded cash. And when Lehman Brothers collapsed, those banks survived. The banks who didn't see it coming, who thought everything was fine, who kept their exposures in place, they either failed or had to be bailed out. Morgan Stanley itself almost failed in 2008. They survived by converting to a bank holding company and getting emergency Fed funding. They learned the lesson. When the risk models show systemic danger, you don't wait for confirmation. You exit first and ask questions later. In 2022, the London Metal Exchange had a massive short squeeze in nickel. A Chinese company had built a huge short position. The price started spiking, and the LME had to halt trading and cancel trades to prevent a default. The people who were on the right side of that trade, the ones who were long nickel, they got destroyed. Not because they were wrong, but because the exchange changed the rules to protect the shorts. Morgan Stanley remembers all of these events. They have institutional memory. They have risk managers who lived through these crises. And when their models start showing the same warning signals, the same feedback loops, the same counterparty stress indicators, they don't ignore it. They act. And they're acting right now. But here's the question you should be asking. If Morgan Stanley knows the system is about to break, why are they telling their clients? Why not just quietly exit and let everyone else figure it out? The answer is legal liability and reputation. If Morgan Stanley exits their own positions without warning their clients, and then the market implodes and their clients lose billions, those clients will sue. They'll claim Morgan Stanley had material information and failed to disclose it. They'll claim breach of fiduciary duty. Morgan Stanley could face tens of billions in legal damages. Worse, they'd lose clients. Institutional clients don't forgive being left in the dark when their advisor knew disaster was coming. So Morgan Stanley is covering their legal exposure by sending the memo. They're creating a paper trail that shows they warned everyone. They advised exits. If clients chose to ignore that advice, that's on the clients. But there's another reason they're warning clients. They need the clients to exit in an orderly way. Because if everyone panics and tries to exit at once, it crashes the market and makes Morgan Stanley's own exit more difficult. By giving clients a month-end deadline, they're spreading the exits out over several weeks. They're managing a controlled retreat. This is not altruism. This is strategic self-interest. But it also gives you, someone who's paying attention, a warning that most people won't hear. Because here's the reality. Most institutional clients who receive this memo will follow the advice. They'll exit their positions. They trust Morgan Stanley. They have risk management protocols that require them to follow advisor recommendations. But most retail investors, most people watching this video, they don't have access to Morgan Stanley's memos. They don't have advisors calling them saying, "Get out." They're flying blind. They're looking at the COMEX spot price, seeing $71, and thinking everything is normal. They have no idea that behind the scenes, the smart money is evacuating. And by the time the retail crowd figures out what's happening, it'll be too late. The exits will be jammed, the premiums will be vertical, the metal will be unavailable. Now, allow me to show you what Morgan Stanley's exit is going to do to the market. Because when a major player liquidates, it doesn't happen in a vacuum. It creates ripples, and those ripples are going to hurt. Here's what the exit process looks like. Morgan Stanley has to close both long and short positions. For the short positions, the ones where they've sold silver futures, closing means buying those contracts back. That's short covering, and short covering pushes prices up. For the long positions, closing means selling. That's liquidation, and selling pushes prices down. So you're going to see violent volatility. The price will spike on the short covering and crash on the liquidation, then spike again as other shorts see Morgan Stanley covering and panic that they need to cover too. This isn't going to be a smooth move. This is going to be chaos. We're talking about intraday price swings of $5, $10, maybe $15. Stop losses will be triggered. Margin calls will hit. Retail traders using leverage will be obliterated. But here's the key insight. Morgan Stanley doesn't care about the price. Remember, the memo said prioritize orderly liquidation over price optimization. They're willing to lose money on the exit because they believe the alternative, staying in, is worse. That tells you how dire their internal assessment is. They're willing to take losses, potentially large losses, just to get out. Now multiply that by every other institution that's going to follow Morgan Stanley's lead. Because once one major bank exits, others will follow. That's how institutional behavior works. Nobody wants to be the last one out. If Morgan Stanley sees something dangerous, other banks will assume Morgan Stanley knows something they don't. So they'll exit too. And when multiple institutions are all trying to liquidate silver positions simultaneously, the market breaks. Liquidity disappears. The bid-ask spreads blow out to ridiculous levels. You'll see quotes where the bid is $70 and the ask is $75, a $5 spread. That means the market makers, the people whose job is to provide liquidity, have given up. They don't want to hold inventory because they don't know where the price is going to be in 5 minutes. This liquidity death spiral is what creates the blow-off move, the violent repricing where the market gaps from 71 to 90 or 100 in a single session. Not because of new information, but because the market structure collapsed. The machinery that's supposed to provide orderly price discovery just stops working. So what should you be doing right now? What's your move? Allow me to give you the strategic framework. First, understand that you have 3 weeks, maybe 4, until month end. That's your window. After that, all bets are off. After Morgan Stanley and the institutions following them have exited, the market dynamics change completely. You're in uncharted territory. Second, decide what side of the trade you want to be on. Are you holding paper silver or physical silver? Because Morgan Stanley's exit is going to create a massive divergence between the two. Paper silver, the futures contracts, the ETFs, the unallocated accounts, all of that is going to become increasingly unreliable. The COMEX might default on deliveries. The ETFs might suspend redemptions. The unallocated accounts might settle in cash at unfavorable prices. Physical silver, bars and coins in your possession, that's going to become the most valuable form of silver. Because when the paper market breaks, when confidence evaporates, the only thing that matters is actual metal. The premium for physical over paper is going to explode. We might see physical trading at a $50 or $100 premium over the COMEX quote. If you're holding paper, you need to convert to physical while there's still time. Yes, you'll pay a premium. Premiums right now are running $8 to $15 over spot, depending on the product. But that premium is nothing compared to what it's going to be after month end. Better to pay $15 over spot today than $50 over spot in 4 weeks. If you're holding physical already, hold it. Do not sell. Do not be tempted by short-term price fluctuations. When Morgan Stanley liquidates, when they sell their long positions, you might see the paper price drop. It might drop hard. You might see 71 fall to 65 or 60. Retail traders will panic. They'll think the bull market is over. They'll sell. Do not be one of them, because that price drop is artificial. It's the result of forced institutional liquidation, not a change in the underlying supply-demand fundamentals. The fundamentals haven't changed. Inventory is still falling. Delivery requests are still rising. Counterparty risk is still increasing. The only thing that changed is that Morgan Stanley is selling their paper positions. Once that liquidation is over, once the institutional exits are complete, the price will snap back. And it will snap back violently because at that point, the shorts will have lost their biggest ally. Morgan Stanley, while they were in the market, provided liquidity. They absorbed selling pressure. They kept things orderly. When they're gone, there's one less buffer, one less source of liquidity, and the path to triple digits becomes clear. Third, watch the inventory numbers obsessively. You need to track the COMEX registered inventory every single day. If it falls below 25 million ounces, you're in the red zone. That's the level where the exchange cannot possibly satisfy delivery requests without defaulting. At that point, the breakdown is imminent. You can find the inventory data on the COMEX website. It's public information. They publish it every day. Set a reminder on your phone. Check it every morning. Make it part of your routine. Because the day that number crosses below 25 million, you have hours, maybe days, to make your final moves. Fourth, pay attention to what other banks do. Morgan Stanley won't be alone. Watch for news of other institutions reducing commodity exposure, other banks exiting silver trading, other advisors telling clients to de-risk. Each one is confirmation that the exodus is accelerating. Each one narrows your window. Fifth, understand that this might get ugly before it gets better. The next few weeks are going to be volatile, chaotic, and stressful. If you're holding physical, you're going to watch the paper price swing wildly, and you're going to be tempted to panic. Don't. If you're trying to acquire physical, you're going to face tight supply, rising premiums, and long delivery times. Be patient. Get what you can when you can. If you're holding paper positions, you need to be making exit plans. How will you close your positions? What's your trigger? What price are you willing to accept? Don't wait until everyone else is trying to exit at the same time. Now, allow me to address the skeptics, because I know what some of you are thinking. You're thinking, this sounds too extreme. Banks exit positions all the time. This is probably just routine risk management. Morgan Stanley is probably just rebalancing their book. To you, I say, read the memo again. They didn't say rebalance. They didn't say reduce. They said exit. They said close all positions, long and short, all expiration dates, and they gave a hard deadline. That is not routine. That is not rebalancing. That is evacuation. And if you still don't believe it, ask yourself this question. Why would Morgan Stanley voluntarily give up the revenue from their silver trading business? Why would they turn away new clients? Why would they accept the reputational risk of looking panicked? The only answer that makes sense is that they see something so dangerous, so catastrophic, that staying in the market is not worth any amount of profit. They're willing to sacrifice revenue, sacrifice reputation, sacrifice client relationships just to get out. That's not routine risk management. That's existential fear. And maybe they're wrong. Maybe their models are overestimating the risk. Maybe the system will hold together and nothing bad will happen. But are you willing to bet your wealth on Morgan Stanley being wrong? Are you willing to bet that one of the most sophisticated risk management teams on Wall Street, a team that manages trillions of dollars, a team that survived 2008, a team with access to data and models that you will never see? Are you willing to bet that they're just being paranoid? I'm not. I'm betting that they know exactly what they're doing. I'm betting that when the largest institutional players in the market start running for the exits, there's a fire. And I don't need to see the flames to know I should be heading for the door too. Allow me to give you one more piece of context that ties all of this together. Month-end is not arbitrary. There's a specific reason Morgan Stanley chose that deadline. At the end of every month, banks have to mark their positions to market for regulatory reporting. They have to calculate their risk exposure, their capital requirements, their leverage ratios. If a bank is holding positions that are underwater, that shows up in their regulatory filings. It affects their capital ratios. It affects their credit ratings. It affects their ability to borrow. Morgan Stanley does not want to be holding silver positions when month-end rolls around because they believe those positions are going to show massive losses on their books. Losses that will trigger regulatory scrutiny. Losses that will hurt their capital position. Losses that will make their quarterly earnings report look terrible. They want to be out before the month-end snapshot. They want their books to show zero silver exposure so that when the bomb goes off, whenever it goes off, they can say, "We weren't there. We exited before it happened." This is also why the memo tells clients to exit before month-end. Morgan Stanley wants their clients' books clean too. Because if Morgan Stanley's clients are holding huge silver losses at month-end, those clients might blame Morgan Stanley for not warning them. This way, Morgan Stanley has a paper trail. We told you to exit. We gave you the deadline. If you didn't listen, that's not our fault. The month-end deadline is about regulatory reporting and legal liability. It's about making sure that when the music stops, Morgan Stanley is already sitting down and they're taking their clients with them. So here's your final action plan. If you're holding paper silver, you have until month-end to convert to physical or exit entirely. Do not procrastinate. Do not wait to see what happens. Every day you wait, the window gets narrower. If you're holding physical silver, congratulations, you're already positioned correctly. Now hold it. Do not be shaken out by volatility. Do not sell because the paper price drops. Remember that the paper price is increasingly meaningless. If you have capital and you want to acquire more physical, do it now. Accept that you'll pay premiums. Accept that delivery times might be long. Get in line while there's still metal available. And finally, prepare yourself mentally for what's coming. The next month is going to be a wild ride. You're going to see headlines that don't make sense. You're going to see price action that seems irrational. You're going to hear experts on television saying everything is fine, while behind the scenes, institutions are fleeing. Trust the memo. Trust Morgan Stanley's actions. They're showing you what's real. The public narrative is going to lag reality by weeks. By the time the mainstream media figures out what's happening and starts reporting on it, the crisis will already be in full swing. You will have missed your chance to act. Don't let that happen. Use the intelligence you have right now. Use the fact that you know what Morgan Stanley is doing. Use the advantage of being early, because in markets, being early and being right looks the same as being wrong, until suddenly it doesn't. And then the people who were early become very, very wealthy, and the people who waited become very, very poor. Morgan Stanley is exiting all silver positions before month-end. That's not a rumor. That's not speculation. That's a documented fact confirmed by multiple sources. The question is not whether it's true. The question is, what are you going to do about it? Are you going to act, or are you going to wait and hope everything works out? I can't make that decision for you, but I can tell you that when the largest institutional players on Wall Street are running, you should probably be running too. The memo is real, the deadline is real, and the countdown has started. You have weeks, not months. Use them wisely.